Hello folks, I'm L.A. Little and this is your daily NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective, each time asking ourselves what happened today and what does it tell us about the coming ones. I do this show 4 times a week, Monday through Thursday, broadcast at or before 10 o'clock Eastern Time, and archived on YouTube. It's under the channel L.A. Little. Available to you anytime, anywhere, any device. Make it easy. Making it easy is not what the markets are doing, though. We had another day down last night, if you remember, and actually one of the members suggested this morning that I sounded too bearish last night. I talked about, the possibility and the potential for a down day today. I actually, as I looked at things this morning, I was a little bit more optimistic, thought we were going to see some sort of a turn towards the end of the day, pressure at the beginning. Not to be. That's not what happened. We did get the pressure today, as we saw from the tells on the tape last night, and we got no relief from it. It just continued. Dow down 272, 1.6%. We had the NDX down almost 1.5%. We had, pretty much all of them down 1.5% here. The one that was down the most, the one that really got creamed, was our old friend, the Russell. Russell down 1.5, 1.6. Let me redraw the screen here again. 1.68, the Russell. So you can see, once again, it was the leader on the downside. Not huge, but certainly the leader to the downside. If we look elsewhere, usually, or not usually, but with the dollar going down, you typically see these bonds and the commodities rallying. Not to be, not today. We had oil down big. Commodities got a little bounce, but not that much. So, turn of events, big day down on the indexes, and this, unfortunately, sets up more pressure. Let's pop over and look at the charts. And actually not that chart. Let me grab the right ones. Let's go to the S&P. Okay, so there's a lot to review here. I'm going to spend a little bit more time on the charts tonight. May not have time for a lot else tonight, but we've got multiple things happening. One is you closed at a lower low. 2 is you're into the hammer bar. Okay, when you get a hammer reversal, now it's possible that you come back down and you test into this, and that's what we're doing 3 days later. What's not possible, but what's not right is if you get underneath it. So a hammer reversal can be tested into, but you can't go back underneath it. And so tomorrow, that's going to be the test on a bunch of these indexes. Or are they going to go underneath this hammer or not? Because if they do, they totally invalidate the hammer. The hammer gave you what the hammer should, and that is you got the reversal spike up. But when you come back down to test it, you have to hold, because if you don't and you break, you're going lower. And in this case, lower is not huge, but it is down. Remember last night we were talking about a potential ABCD structure. That structure gets you down into this price area. Exact price is about 1919. So I drew that a little bit too far to get you back down into here somewhere. But that is damage, right, that's waiting to happen, trying to fulfill. What we've already had happen is if we already had the bounce back over this swing point low, got just over back underneath it, right, almost got into the other one, failed, came back, now you're down on the other side of it and you're trying to set up the ABCD structure of the downside. And what is a real problem, if it happens, is that a push down here, those lows you see on the daily is this low on the weekly. If you break this low, you have set up the same thing that we've seen in the Russell already, and that's an intermediate term time frame change in direction, in trend. Now to go, let's talk about this stuff a little bit today. And if you want my summary and you want to, cut out now, the summary is we're probably going lower tomorrow. there's going to be more detail, but that's the summary. But I'm going to segue now and actually do some more detailed analysis without flipping around too much here. When you transition trend on the intermediate term time frame, it's significant. If you go back and look, the last time we transitioned trend on the intermediate term time frame was 2000, I think it was 2011. I don't have the data in front of me. It was either 2012 or 2011. I think it was like October of 2011. As a matter of fact, if I go back and look over here on a monthly, I can probably find it. Yeah, it was 2011. So that's the last time we transition trend. If you transition trend, it does not mean that it's a bear market, because you're coming from bullish to sideways. Sideways is an intermediate term place. It can regenerate, go back up, or it can break down. What you're always concerned with, especially when you had a bull market as long as this one, is that you're nearing the end, and that those transitions turn out to be something more than just a pullback, reset, rally higher. In this particular case, and in all cases, you don't know that a priori. You don't know for a fact what it's going to do. But you can continue to look for clues such as the fact that it's been going extremely long now and it needs a reset. And a reset can actually make it bullish again. And what I'm talking about, and let me go pull up the cube, is we've got a 97 percentile cumulative probability of failing. That's huge. I mean, that's like overboard. I've only seen it one other time that in the data analysis that I did. So we know that we're at an extreme in terms of the way this market has moved up. And one only has to look at a monthly chart to see that. I mean, this thing's straight up since 2011. I mean, it's not even taking a break. So to get a retest, or not a retest, but a reset, is a good thing. It's going to be painful short term, but it's a good thing. It's not a bad thing. Markets can't go straight up forever. They have to reset. And if you go look at the numbers from FactSet, the price versus the earnings projections, right, the earnings per share, they're actually more, how do I want to say this? I don't want to get it wrong, but there's some data. Actually, I'm going to print an article pretty soon on this, but you know, that includes this FactSet data. But that data shows that the earnings per share price, they've come down, whereas the price per share hasn't. And we're talking about the S&P 500. It's a disconnect. You know, one of them's wrong. Either the earnings per share really are higher than we think they are, and we got earnings coming out next week. You know, the meat of it starting next week. Or price is too high and it needs to come down, one or the other. The market is telling us, at least now, right? Because the market is supply and demand. It's people's perception about what the value is. And right now it's telling us that it thinks it's too high. My take here, my expectation, is that we're going to come down, we're going to fall just short of this, we're not going to break it yet. Now I say that as a caveat with the Russell, and we'll get to the Russell here in a second, but it does appear that we're fixing to break lower. We're going to get down to these swing point lows and we're going to test them, but they're going to be hard to break the first time down. But we'll see as we get there. Let's look at the volume real quick here. So we got 35 on average, so that's about 150, 175, and we did 162 there. So we will have the volume as we come down there. So, you know, my point is we're getting close to these lows. These lows are not that far away. 1904, price point today, 1935. 30 points you can lose in a day. You know, 2 days easy. We're on Tuesday. So we can definitely come down and test this thing this week and potentially break it. That break, it's not the end of the world. What the issue will be if we get these breaks, and we did get it on the Russell today, again on the daily, and it's happening on the weeklies, is that it's going to be all about the bounce. Can this thing bounce, or will it fail on the bounce? We just saw the failure on the bounce on the daily, right? We came up 2 days straight, we went up, we tested, we failed, we noted that last night. That's what made us bearish today coming in, and we got the follow through the downside and volume picks up. I mean, you couldn't ask for anything more if you're a bear, right? 2 day bounce that fails. Those are like almost impossible anymore, or have felt that way. The other thing that's happening here that tends to make me a little bit more bearish is everything I read is about how you got to buy this 4% dip. That dip, everybody's talking about the 100-day moving average, or they're talking about their channel lines, or they're talking about something. And in all the cases, they're talking about how, this is the time to buy, right? This is where you make the buy. Folks, it doesn't work that easy. If it did, everybody'd be out on the beach sipping their, margaritas. The market gets you used to something, and then it changes. That's the way it works. It's just the way it works. All right, so that's the S&Ps. If you look at the Dow, you got the same setup, nothing different here. It's basically doing exactly the same thing. All of them small ABCD structures down to get them down into these lows. NASDAQ. Now the NASDAQ is coming after that low faster than the others, other than the Russell, of course. The NASDAQ's going to come after. It's got an ABCD structure, did the same thing. Volume expanding, right? This thing has a price point of 43.43 roughly is where it's trying to get. That's right down here at the lows. The NDX, strongest index out there still, coming down again. This one finally has broken the retest regenerate. Again, another bearish signal. If you didn't need but one more, here's another one, right? Remember, it held here, regenerated higher. Well, it just fell today. ABCD structure gets it down to about 39.12. So that's going to bring you down into, this price point. So as you can see, they're all trying to get back into that little cluster back in August. Those clusters are the swing point lows on the intermediate term time frame on all these indexes, with the exception of the Russell, which we know to be a different beast, and let's go look at that one. Here's the Russell. Breaks the swing point low today, has less volume, and actually it's not a swing point low. Let me take that back. Breaks the low from last week. Remember, you got to have 6 bars to be a swing point low. It's just a low. So it's just a continuation, but the problem here, and this is what makes me more bearish, is that you've got a huge ABCD structure we talked about last night, I believe, that takes you way down, another 2.5% or so. That structure takes you down to 1048. 1048, remember that number. Let's pop over to the weekly. 1048 gets you down into this area. Where is that? It's bringing you back into the bottom of this bar. That's 1053. So, to highlight it here for you, 1048 is going to bring you right back into here somewhere. Okay? What does that do? Well, when it finally does this, if it does it, it's going to break 1, 2, 3, 4. And it's already broken this one. 5 swing point lows. They don't usually line up like this. When they do, they're deadly. And they're deadly because once you break them, just imagine the situation here. Anyone that has bought over this time period, and this is back to September of last year, will be or is in a losing position. If they've held on average, they're losing. That becomes a significant resistance on the way back up. So if you assume this thing does the ABCD down and gets down into this price area, right, or actually into this price area, right, when it bounces, it's going to have all kinds of resistance on the way back up. Now the good thing, if you want something good, is that these ABCDs, not the ABCDs, these retest regens are going to be big. So in other words, if you just look back at the lowest of the ones, and I believe it's this one, you know, the top of that bar is 1115, right, 1115. So you could get a serious bounce on the way back up. So let's just assume we make it down there and assume we get the full retest regen and then fail. You can see as you come back up into all this resistance that will be resistance if we break. If you do fail and regenerate lower, which is fairly probable, it becomes an even larger issue. And so this is the structure that can kill portfolios. And if you're not aware of that, rewind the tape, watch what I'm saying, go look at some of the articles that I've written over time that talk about the structure that leads to bear markets and leads to crashes. I'm not saying we're going to get a crash, so don't take me wrong here, but I'm saying the structure is in place for a much larger percentage loss than you want to bear. And so be aware of that and recognize that you have to protect yourself if in fact this does start to break down and break away. And if you don't do it here and you want to wait, that's fine, but when the bounce comes, if the bounce fails, you're probably going to want to get out of the way. All right, so that is the Russell. That's the indexes. I spent a lot more time on that than usual, but you know, I don't need to really go too many other places to show you what else is what else is happening. Let's just go to the world markets for the next piece of the summary. You know, we've got things, anything tied to China has been under pressure. Here's the all ordinaries traded under the low, back over it, right? Hammer reversal, but it has volume. It's going to go right back and try it again. India, the poster child of gains this year, right? These guys have had a huge move for the year. You know, they're up, I don't know, 6,000 points. So they're up like 30% or something on an index, which, you know, is kind of like mirroring our stupid moves last year. They're trying to break down. Brazil got a big boost out of the election. I don't know if it's going to go very far, though. I mean, nice big boost, but it looks to me like it probably will play out and probably head back the other way once other things take effect. If I go to Europe, ABCD structure on the way down again. You know, this is the CACs. So we're coming down, we do a bounce, right? And now we have the ABCD structure to the downside that does what? Comes down, tests the lows. Looks familiar, right? Looks exactly like what we're doing. FTSE hasn't quite done it, but is trying to set up the same thing, and it's even weaker. The DAX already done it as well. Broke it down. It's coming down lower. You know, folks, it's an ugly situation. This one never even put in a B point. That's how bad it's been. Toronto, you know, heading back to the lows. They left volume at the lows. They're going to go test them, try to break them down. The only two places that bounce is where everything else, you know, has continued down is China. And I suspect this one's going to flip around and come back the other way as well. Weak bounce, right? The pressure here today, I suspect this is going to flip around, come down, try to test lows again. The Hang Seng, the Hong Kong, they both look the same. Again, all across the world markets, same sort of picture. Last night, you know, I kind of reinforced the thought that we'd probably see pressure today as a result of the sectors. Well, they didn't get any better today. If anything, they got worse. Here's the IYT breaking down. And if I just go through these, you'll see just breakdowns everywhere. The SOX breaks down, ABCD structure of the downside. XLB, it's under last week's lows. That's another huge ABCD down now, all the way from the top almost. So big ABCD structure to the downside. XLE. This one was relative outperformer today, but what does it do? It goes up, it tests this high one more time, fails again, going to go test the low again. XLF. Big ABCD down. XLI, or potential, right? XLI. The XLI also under last week's lows. ABCD structure takes it to the low here. It's going to test this low. Low's got volume, probably doesn't break it yet. Going to test it. XLK, not as bad as the rest, but trying to set up a potential ABCD down. The only other one that's not safety is XLY, also going after the lows. And then we go to the safeties, XLV, still hanging in there, and the reason they're hanging in there is the IBB hasn't crashed yet. If the IBB starts to give it up, folks, this guy's going to go right along with them. The only two safeties outside of that, XLU, long tails to the upside. It pushes up every day and then gives it up, but it is a go-to sector for quote-unquote safety. XLP is the other one, because as rates go down, as interest rates go up, the bond prices, let me say it again, as interest rates go down and the bond prices go up, that helps these two sectors. They pay hefty dividends. Okay, so, the long and short of it, it doesn't mean we're at the end. It doesn't mean the bull market's done. What I'm trying to say is that there are times that are safer times to be invested and times that there aren't. This is not one of the safer times. There's possibilities galore. There's always possibilities. And, anybody that's a fundamentalist can argue about, this or that and say, this is going to happen or that's going to happen, and therefore, we're going to go up. And somebody else can come along and argue the exact opposite. It doesn't matter what you argue. It just matters where people put their money. Do they sell when prices get lower, or do they buy? Do they sell when price gets higher, or do they buy more? That's supply and demand. It shows up on the chart, right? And if you can identify those areas on the chart that are significant so that you can make some judgmental calls on whatever happens, you're that far ahead of most everybody else. And when we looked at the S&P 500 and we saw this test failure last night, and specifically for those of you who didn't see the show last night, this bar is a breakdown bar. Why is that? Because it is where price broke down from the prior little range that had developed, broke down, wide price spread, heavier volume. It's a breakdown bar. That's a significant bar. When you come back up into it, you test the top of it, and they sell it. They don't buy more. They start selling. In other words, the buyers disappear. That's demand disappearing. That's a significant place. That tells you something. Just as tomorrow, if we come in here to test this and we hold it, that will tell us something. If we break it, that will also tell us something. As a matter of fact, what really tells us something is this little area right here. Because why? That's the bottom of this breakdown bar, and that's the bottom of that hammer reversal. That's a significant area. If you can recognize the significant areas, then you can interpret what the chart's telling you. And you can use that knowledge to make decisions that are valuable to you. Okay. I'm kind of tired. It was a long day. I don't have a lot of time left. I don't think I'm going to try to delve into anything else. I did not have any questions today. Folks, if you have questions, you're more than welcome to shoot me an email. And, that email is over here on TA to TV. Just pop in here and you can get the address. One last thing before I go, though. I want to show you one other thing here with the market trends. It's important to realize what the trends are and what they're doing. It's also important to recognize, and I say this a lot, is that once you start getting 2, 3 of them to change, right? And we've got 3 at this point on the sectors, and we've got 1 on the index. Once you start seeing 2 to 3 of these change, it's almost inevitable they're all going to change. It's just the way it works, right? Basically, you've got individual stocks, and I've said this before, but I'll do it one more time. You know, you got stocks here. Stocks drive sectors, sectors drive markets, right? So there is a clear relationship between these in that stocks drive the sectors, sectors drive the markets. That's a bottoms-up approach. When enough of these start heading down, the stocks, that's going to put more and more pressure on the sectors, and eventually you're going to see these start to head down. And if that continues long enough, right, because this has to do with time. Remember, this is, you know, we're talking about daily, weekly, monthly. It takes time to change these. It takes time to change these versus those. Once enough time passes, if that pressure continues, you're going to see the same thing over here on the indexes. And then you're going to see conversely, not conversely, but in parallel, you're going to see the different time frames show the damage. For example, all of these have already gone bearish almost. Now you're starting to see it here. You're starting to see bearish ones here, here, and here. And as we just showed on the sectors, you're going to see others potentially start to give it up. In particular, the financials are close. Discretionary is close on an intermediate term time frame. You know, there's others. So, and the industrials are close. Once you get 2 to 3, then it's very easy to get the rest of them. Matter of fact, most of the time that is what happens. So, you know, be aware of this chart and be aware of this relationship because, you know, trend, you have two things in neoclassical, and that's all there is. You know, there's all these other little, I wouldn't say rules, but there's these interrelationships that are valuable to know. But there's two things you have to know. You have to know trend, which is which way do I point, and you have to know supply and demand as you see it on the chart, right, which is your timing. So you need direction and you need timing. And that's what it's all about, right? With that, you can tackle anything. Folks, thanks for joining me. I appreciate you being there. You tell a friend, tell two. You know, on YouTube, you can actually, you know, repost this so others can see. Push it to your Facebook, wherever. The more you spread it, the more the word spreads, the better it is for all of us. Help me help you. I'm LA. Take care of yourself. I'll see you next time. Good night.